Today, we're going to explain one of the most dramatic price swings in the silver market in recent memory. A sharp crash where silver prices fell more than 10% and in some cases experienced even larger single-session plunges across major markets. This isn't just a chart pattern. This is real market consequences driven by a confluence of macroeconomic news, speculative positioning, technical triggers, leverage selling, and shifting investor expectations. By the end of this video, you'll understand exactly why silver crashed, what the root causes are, what major players, analysts, and traders alike are saying about it, and most importantly, where the market might head next. In early 2026, silver had staged one of its most spectacular rallies in years. Prices surged into triple-digit territory above $120 per ounce, astonishing many traders and investors alike. But by early February, that rally began to unravel quickly, and what followed was a series of sharp declines, dramatic sell-offs, and volatile swings that had the entire commodities world talking. Markets are by nature cyclical and subject to changing sentiment, but the speed and depth of this move shocked even seasoned observers. So let's break down why this happened. First, it's important to understand that silver isn't just a precious metal like gold. It's also an industrial metal. Over half of global silver demand comes from industrial applications such as solar panels, electronics, automotive components, and medical instruments. Because of this dual nature, part investment asset, part industrial commodity, silver tends to move more violently than gold when sentiment changes. The silver crash has several major causes, but we can group them into a few key themes. First, after the rally, traders locked in profits. Silver made extraordinary gains in late 2025 and into early 2026, catching everyone's attention. Those steep gains meant many traders, especially short-term speculators, had large unrealized profits. When a market reaches extreme levels, professional traders and hedge funds start reducing positions simply to lock in gains, rather than waiting for further upside. This profit booking creates downward pressure in prices, because as soon as some traders start selling, it puts pressure on prices, which in turn triggers stop-loss orders and adds to the selling. Once that downward momentum begins, it can create a cascade effect, where selling feeds selling. This phenomenon is especially powerful in markets like silver, where liquidity, while significant, is much less than in markets like gold or large stock indices. When selling accelerates, it can move prices faster and deeper. Macro shifts, interest rates, and the US dollar. One of the biggest drivers of precious metals prices is expectations about interest rates and the strength of the US dollar. For much of the rally, markets had positioned for eventual rate cuts by the Federal Reserve, which would typically be bullish for non-yielding assets like gold and silver. However, stronger US economic data, including robust jobs numbers and resilient growth, forced traders to rethink rate cut expectations. As markets started to price out the likelihood of earlier rate cuts, bond yields rose, the US dollar strengthened, and suddenly silver's opportunity cost of holding, compared to yield-bearing assets like bonds, increased. When that happens, investors shift capital out of commodities and into assets that pay interest, which further depresses metals prices. The result? Strong dollar plus higher yields equals downward pressure on silver. 3. CME margin requirement hikes. A more technical but extremely impactful reason for the crash was the increase in margin requirements on futures exchanges. Many traders trade silver futures using leverage, meaning they control large positions with relatively little capital down. When the Chicago Mercantile Exchange CME raised margin requirements, it suddenly became much more expensive for leveraged positions to remain open. That forced many traders to either post more capital or close their positions, and most chose to sell. This forced liquidation created a wave of selling that flooded the market with supply and forced prices lower. This wasn't an overnight change in fundamentals like demand or supply. It was a regulatory and leverage-related trigger that forced traders' hands. Speculative positioning and crowded trades. By late January, speculative positioning in silver was extremely elevated. Large numbers of long positions, bets that prices would keep rising, had built up, especially in futures markets. That data was visible in commitments of traders' reports, showing speculative interest near multi-year highs. When markets are crowded on one side, especially the long side, any shift in sentiment can cause a rapid unwind. As soon as price action turned bearish, these leveraged long positions began to unwind quickly. Stop losses were triggered, margin calls piled up, and the combination magnified selling activity. This is a classic blow-off pattern, a rapid rise followed by a faster fall once sentiment changes. Sudden sell-offs and flow-driven moves. A notable and widely discussed moment in the crash came on February 12th, when silver prices suddenly plunged more than 10% intraday. Analysts describe this move not as a reflection of a fundamental shift in silver's long-term outlook, but rather as a flow-driven market event, meaning traders adjusted positions rapidly in response to broader market flows rather than immediate changes in demand or supply fundamentals. What this essentially means is that markets were behaving like a crowded theater with only one exit. Once sentiment turned, the rush to exit positions amplified the price drop, well beyond what any fundamental factor alone might justify. Volatility amplifiers, spot versus futures, and liquidity imbalances. Another technical but often overlooked cause of extreme moves is a discrepancy between spot and futures prices. At times during the crash, spot silver, the actual physical market price, diverged significantly from futures prices, the price of contracts traded on exchanges. These gaps create market distortions that can prompt further forced selling or buy-in activity, adding to volatility. Silver's market is less liquid relative to gold, so these arbitrage and price discovery issues can trigger sharper swings. So the crash wasn't the result of one single event. It was multiple factors converging. Traders were sitting on huge profits, rate expectations changed, leverage cost went up. Speculative longs got squeezed, forced selling amplified the move. Technical and liquidity pressures accelerated the fall. Now let's talk about what this means in real terms. Silver went from record highs, above $120 per ounce, to prices in the low to mid-70s in a matter of weeks, a drop of more than 30% in extreme sessions. In some markets, like the Indian MCX exchange, silver prices dropped sharply by more than 15% in quick succession. The chart action reflected a classic capitulation phase where buyers stepped aside and sellers dominated. But sharp declines often create second-wave opportunities for investors and traders. Market psychology and the crash narrative. Here's something crucial. While headlines talk about a crash, many analysts emphasize that this isn't necessarily the end of silver's long-term bull case. Instead, what we saw was a severe correction within an ongoing volatile cycle. Analysts point out that silver's rally was partly driven by speculative positioning that outpaced fundamentals, creating an environment where even modest negative catalysts could cause exaggerated price swings. Silver remains deeply tied to macro sentiment, particularly interest rates, inflation expectations, and industrial demand. When sentiment shifted abruptly, prices corrected sharply, but the foundation of demand, especially industrial usage, hasn't disappeared. Automotive, solar, electronics demand still exists, and supply remains relatively constrained in many regions. So while prices dropped violently, that doesn't necessarily mean silver has broken. It means the market is repricing risk, expectations, and macro signals. What could happen next? When markets crash, the big question is always, where do we go from here? There are three plausible scenarios. Bullish scenario. If the broader macro landscape begins to favor weaker interest rates, for instance, if US inflation data softens more than expected, markets could price in Fed rate cuts. Lower rates and a softer US dollar historically benefit precious metals, especially non-yielding assets like silver. We've already seen some rebound activity when buyers step in on dips near key support levels. This dip buying could stimulate a rally back toward previous resistance zones if sentiment shifts. Analysts at major banks have even suggested a possible return to triple-digit price territory in the medium term if conditions align. Neutral scenario. Silver could settle into a consolidation range for a period of several weeks or months. Markets rarely move in straight lines after violent moves like this. They often form base patterns where support and resistance levels are tested repeatedly before a clear trend emerges. In this scenario, silver might trade sideways between major levels, for example, between $70 on the downside and $90 to $100 on the upside, before market-wide catalysts determine direction. Bearish scenario. If the US economy continues to show strength, keeping interest rates elevated and the dollar firm, this could limit silver's upside and keep downward pressure in place. Continued liquidation of leveraged positions or additional margin increases could also contribute to further short-term declines. Under this scenario, prices could test new lows below recent support before stabilizing. Long-term outlook. Despite the volatility, many analysts believe the long-term fundamentals for silver remain structurally supportive. Industrial demand, especially from solar energy and electronics, ongoing supply constraints, and retail investment interest contribute to a supportive backdrop. Unlike gold, silver's price action can be far more violent in both directions. This volatility is less a sign of market breakdown and more a reflection of how highly leveraged and expectation-driven the silver market has become. So here's the takeaway for traders, investors, and anyone tracking the silver market. The crash wasn't caused by a single event. It was caused by multiple pressures converging at once. Macro shifts in rate expectations and dollar strength were key catalysts. Margin hikes and forced liquidations amplified the price declines. Sharp corrections are painful, but they can also reset sentiment and create opportunities. The future direction hinges on inflation data, Fed actions, and global economic resilience. Remember, in volatile markets like silver, fundamental demand still matters, even when price action is driven by sentiment and positioning. If you learned something new in this explanation, hit that like and subscribe button. We break down markets every week with real data and real answers.